Hi, so welcome to the live stream today. Really excited for having you on the stream as we continue with our discussion for the December 2022 examination. And we are going through the IFRS masterclass where I take you through the key accounting standards that you need to focus on in order to increase your chances of passing the examination. But most importantly, during these streams, we are able to solve specific questions that are tailored to enable you to really understand the standards so that when you are asked a question, whether the standard related or it is part of a footnote in the financial statement preparation, you will be in the position to be able to write out or answer the question and most importantly, pass the examination. Now, if you have not been following, we've done IAS 2, we've spoken about IAS 10, we've spent some time on IAS 8 as well in that regard, discussing the IFRSs. So, in case you missed any of those sessions, you can check the description of this video on YouTube. If you're watching on YouTube, the description of this video, you will see all of those videos as well and go and watch them. We solve specific questions relating to these standards to enable you to pass the examination. Our focus today is going to be on IFRS 15, revenue from contracts with customers. One of the fundamental standards that you need to understand. Now, the reason why the standard is important is also because the standard has some relationship with IFRS 16 leases and has a relationship also with IFRS 9 when we are talking about issues relating to financial instruments. And revenue recognition is something that is fundamental that we need to understand. So as we are preparing for our corporate reporting or financial reporting examination, revenue recognition will always be something that we need to understand very well to position ourselves to pass the examination. So that is what we want to go in today to share our thought on IFRS 15, revenue from contract with customers. It is in two parts, so I'm going to take the first part today. Tomorrow, we're going to be taking the second part of IFRS 15. On Wednesday, we're going to be going into IAS 33, that is earnings per share. So throughout the week, I'll be coming your way as we continue with the IFRSs. My goal, as always, is very simple: to enable you to really understand these standards so you can position yourself to pass the examination. So give us a thumbs up on the video. For those of you who are joining us and watching the video as well, give us a thumbs up. It helps us a lot to reach many students because that is how YouTube and Facebook can push the video across all their platforms. And also share the video. Let's get a lot of students watching the video and let's together assist more students and let's together become successful. That is the main goal for these live streams. So let me bring up my screen and let's get excited about today's discussion. Remember that books are available, the financial reporting book and corporate reporting book available that you can get access to for your examination. We cover all the standards, everything that you have to understand in financial reporting. Then there is the corporate reporting volume 1 and 2 also available that you can get access to. So you can reach us out the number on your screen and you'll be able to be assisted to get access to this as well. So some shout outs real quick: Nana Don, Rukaya Mohammed, Emmanuel Owusu, Okran, and Doris Owusu and San. Thank you very much, guys, for the thumbs up on Facebook. Thank you very much. Really appreciate it. And so if there are any questions, also, you know what to do. Put it in the chat for me. Want to hear from you guys as we continue with our discussion. What is this? Oh, sorry. This is our PSA class this evening. Let me open up my slide for YouTube. There we go. So let's go IFRS 15. Revenue from contracts with customers. Let's shift this a little bit. With customers. So, like I mentioned, this is a very fundamental accounting standard, and we will be going through these standards to enable you to really, really prepare well for the examination and pass the exam. So, make sure you stay connected, and if there are any questions, you put it in the chat for me. Remember also to give us a thumbs up as we begin to dive into this discussion. So, IFRS 15 revenue. Every company exists because they want to make profit. Okay, like profit making organizations exist to maximize the wealth of the shareholders. But in order to maximize the wealth of the shareholders, they must be able to generate revenue, so that the revenue must be able to then exceed the expenses, then they can make profit. But when revenue is being generated, it is very important we identify when the revenue can be recognized in the books of the entity. Because if we don't have rules on when revenue can be recognized, then an entity will just say that, okay, we expect to receive whatever, something, $100 million. Because of that, we will include it in a current year revenue. What is going to be happening is that they are likely to then overstate revenue in one accounting year and understate revenue in the subsequent accounting years. So, what then that means is that if there is no rule on how revenue is supposed to be recognized, then it will go against the qualitative characteristics of financial statements, which is faithful representation and relevance at the end of the day. It is for this reason why the standard IFRS 15 is very important to provide the guideline and the blueprint on how entities can recognize revenue generally. So we're going to be looking at this in two perspectives, like I mentioned, because one thing you must understand is that this standard IFRS 15 is actually replacing two previous accounting standards, the IAS 18 revenue, and then IAS 11 construction contracts. So it's actually going to be it's actually replacing these two standards, and so the standard describe and explain the treatment in these two categories. Now, what does that mean then? It means that by default, what happened in IAS 18 was that entities recognize revenue immediately the transaction has taken place. What does that mean? It means that, for instance, an entity signs a contract. So let's say an entity signs a contract of $1 million, and they signed a contract on 1st November, let's say 2021. And their year ended is 31st December 2021. That is their year ended, 31st December 2021. But then this contract that they have signed, they started work on the contract, or they will start work on the contract somewhere on 2nd February 2022. Somewhere on 2nd February 2022. What does that mean? It means that as of the year ended 31st December 2021, no work had been done on this contract that was signed on 1st November 2021. And if no work has been done, then you cannot recognize any revenue in respect of the $1 million in the year ended 31st December 2021. But under IAS 18, because of the fact that, transaction is recognized when the transaction takes place, the entity end up usually recognizing revenue, including the 1 million in the 31st December 2021, justifying that, we signed a contract before the year end. But they actually will start working in the subsequent year. When this happens, it means that the profit of 2021 has been overstated, whilst the profit of 2022 will be understated due to the timing of the recognition of the contract and the time that work was actually undertaken. So to avoid this, that is where IFRS 15 comes to town. I hope you're getting the premise very well. To avoid this, that is what IFRS 15 comes to town. This is the key takeaway. If you're going to forget anything, don't forget this takeaway. So this is my key takeaway. Give me a moment. I think my pencil is a little bit messing me up. Let's see if I can get it to come up a little bit. Okay. So my key takeaway is this. This is the key takeaway. If you forget anything, don't forget this one. That under IFRS 15, that's the ultimate thing. Under IFRS 15, revenue is recognized when a performance obligation is satisfied. Period. So that is the first takeaway I want you to have. Before we even dive into what the heck the standard is about, the breakdown of the standard, the first takeaway is that here we only recognize revenue when a performance obligation is satisfied. What is a performance obligation? A performance obligation is simply the goods to be transferred or service to be rendered to the customer in exchange for the consideration received. That's it. Performance obligation refers to the goods to be transferred or the service to be rendered to the customer in exchange of the consideration received. What does that mean? So let's say that we are a company that's, um, we let's say we provide education, so we teach, all right? So teaching services or tuition services, whatever the heck. It means that we will recognize revenue after we have provided the service. That's all. After we've provided the services. Okay, we sell goods. What can we sell? Okay, let's say we sell. What do we sell? Let's say we sell air conditioners. If we sell air conditioners as a company, when do we recognize revenue? We recognize revenue when the air conditions have been transferred to the customer or when we have agreed to the customer that we have transferred risks and rewards to the customer. And I'm going to explain that also in a moment. Stay with me very carefully here. So that is the key takeaway I want you to have. That under IFRS 15, revenue is recognized when a performance obligation is satisfied. It is when we have done the work, the risk and the rewards associated with the goods has been provided. Let's say we install air conditioners. Still in our illustration, we install air conditioners. Okay, so when do we recognize revenue as air condition installers? We will recognize revenue when we have finished installing and the customer says, I am satisfied, the air condition is working well, that was the place I wanted you to fix the air condition, and everything is good. Then we can recognize revenue. So that is the primary thing. Okay. But in some contracts, what's going to be happening is that the customer it's likely to make some advance payments. So the question we then ask ourselves is, suppose the customer makes an advance payment and we had not rendered any services, how do we recognize that? Because since we have not rendered any service, then we are supposed to we cannot recognize revenue. So how do we treat that advance payment? And that is takeaway number 2, that any payments received in advance shall be recognized as deferred income. That's a liability. It's a liability. So any payments received in advance shall be recognized as deferred income. That's a liability. Because we now owe the customer. We owe the customer. So the customer has paid us in advance because probably the exchange rate and the Ghana cedi now above $11 and all that. So the customer has made payment in advance. Okay, you receive the money, but You've not done anything, so that becomes a deferred income. And deferred income are liabilities. And so to be recognized on the face of the statement of financial position, it will be recognized on the face of the financial position. No P&L. No P&L situation. It's in the face of the statement of financial position. On the face of the statement of financial position. All right. So principle number one, under IFRS 15, revenue is recognized when performance obligation is satisfied. Principle number two, any payments received in advance shall be recognized as deferred income. Now, number three takeaway I want you to have, the third takeaway I want you to have is that sometimes the revenue is due, but had not been received yet from the customer because of the nature of the contract. So if it is due, we have satisfied the performance obligation, but we have not received the money yet, then it will be recognized as contract receivable, and that is an asset on the face of the statement of financial position. So three, where a performance obligation. Now, from now on, I'm going to take PO to be performance obligation. Okay. So when I write PO, I mean performance obligation. So where a performance obligation is satisfied, but the amount is yet to be received. But the amount is yet to be received. The entity shall recognize revenue with a contract receivable. And this is an asset on the face of the statement of financial position. It depends on the contract. It could be recognized as a current asset or a current liability, depending on the contract we have available or the nature of the contract. It can be an asset or, a long-term asset that is non-current asset or current asset. That is the idea about that. And like I said, all of these things, you're going to see them play out in a moment as we jump into our discussion. So these are the key takeaways that I want you to have generally when it comes to IFRS 15. If you're going to forget anything, these three things should be with you. Okay? These three things should be with you. So if you look at it in general, it means that IFRS 15 has two categories. The default issue, I'm going to put my illustration a little bit down here. The default issue, which relates to the treatment of revenue. So default revenue recognition. And then revenue recognition where performance obligation goes beyond one accounting year. So these are the two things. Beyond one accounting year. So there is the default normal one, selling of goods. Then there is another one, which is where performance obligation goes beyond one accounting year. We are going to be focusing in the next few minutes on the default revenue recognition, normal one. Then God willing, tomorrow in the part two, we're going to be focusing on where performance obligation goes beyond one accounting year. All right. So stay with me carefully. So if these are the various issues that we need to understand, the question is, how then do we recognize revenue? Now, remember, I've already stated that revenue is recognized when a performance obligation is satisfied. But that is the bare minimum. That is the final thing. The reason is that IFRS 15 describes a 5-step framework for revenue recognition. So the 5-step framework, and this can be asked by the examiner for theory purposes. The 5-step framework. Of revenue recognition. 5 step. So this is a theory part that the examiner could throw at you in the exam hall for maybe 3 marks, 3 marks. And I always say, if you have seen 47 before, you appreciate 3. So there are 5 steps that we go through, or 5 stages we go through when we talk about revenue recognition as per IFRS 15. So I'm going to be going into my slide here in that particular case and then share thoughts with you. I'm coming in from our book on financial reporting or corporate reporting. So those of you with the book, you can go with me to page 22255 because I'm going to explain the 5-step framework generally there in that case. 5 step. Step number 1, identify the contract with the customer. That is the first step. Before we can talk about revenue recognition generally, the first thing we have to ask ourselves is there a contract with the customer? Now, to be able to answer the question of whether there is a contract with a customer, there are certain conditions that must be met. Number 1 is that the contract has been approved by both parties. So in other words, both parties have signed the contract and say, okay, so let's give an example. So we can give an example that let's say that we have whoever, let's say we have someone, Tracy, contacts Nhyira to provide tuition services. And so the first thing we need to ask ourselves is there a contract? Yep. So for instance, Tracy said, I want tuition for 6 months. And Nhyira said, yes, I will provide tuition for 6 months. Is there a contract? Yep. And the 6 months, Nhyira said, okay, I'm going to charge $10,000. And Tracy said, yes, I'm going to pay. So we have to first find out, have the 2 parties approved the contract? That's number 1. Number 2, each party's right in relation to goods and services to be transferred can be identified. So we know exactly what we are getting. Okay, so Tracy says tuition for 6 months, and Nhyira is going to provide that tuition. So Nhyira's work is the tuition here, and Tracy is going to be paying the money generally. Then 3, the payment terms for the goods and services can be identified. Okay, so how will this $10,000 be paid? It has been agreed on. Maybe you pay all upfront before the class starts, or you pay 70%, then 2 weeks after the class starts, you clear the rest. It has been stated out. The contract has a commercial substance. Definitely, there is money on the line, $10,000. You can see that. And then it is probable that the consideration will be received. That is very, very important. Because it is one thing to charge a client, it is another thing for the client to have the capacity to be able to pay for the goods. Okay, to be able to pay for the goods. So it is probable that after 6 months, we're going to be getting our $10,000. If all these things are present, then we can conclude and say that step number 1 checked. There is a contract with the customer. That's the first thing. So in every question, the first thing we need to identify about revenue is to ask ourselves, is there a contract with a customer? Now, technically, you may not be able to identify all of them, but you can infer from the structure of the question whether there is a contract with a customer. But that is the first step. Then we come to the second step, identify the performance obligation. Remember in a few minutes ago, I explained what performance obligation is. In a simple language, performance obligation simply refers to the goods or services to be transferred to the customer in exchange of the consideration received or receivable. So if we go back to our illustration here for Nhyira and Tracy, Nhyira is going to be providing tuition services, number 1. Let's say Nhyira is going to also give books as part of the deal. Number two, let's say that insurer is going to have organize an exams, a mock examination as part of the contract. That's the performance obligation. All right. So that is the idea. That is the idea. So tuition services, books, mock examination. That is the performance obligation. In every question, you have to identify what is the company doing. What's the role of the company here? You need to be able to identify that. That's the second thing. Step number three. We determine the transaction price. Very important. The transaction price. How much do we expect to receive in exchange of the goods that we are transferring or the services being rendered? That is the transaction price. So, in the context of our illustration here, our transaction price will be equal to the $10,000, the amount we will receive when we satisfy the performance obligation. The amount we will receive or the amount receivable when we satisfy the performance obligation. But the fourth step is where the journey begins to get interesting. And I want you to stay with me very carefully here, because the fourth step is to allocate the transaction price to the performance obligations in the contract. What does that mean? Because remember that it is likely we are going to be rendering more than one services for the amount of money being received, usually under the deal. So if you look at it here, the question we ask ourselves is, what are we doing? What is insurer doing under this deal? Insurer is providing tuition. Insurer is giving books. Insurer is organizing mock examination. All three for $10,000. The question we ask ourselves is, if insurer was providing tuition alone, how much will he charge? The books alone, how much will he charge? The mock examination alone, how much will he charge? That is what we refer to as the standalone prices. So we're going to be using the standalone price of each of the performance obligations to allocate or share the transaction price. So let's go through this together so you understand what the heck we're talking about here. So if tuition services, insurer might have charged maybe $7,800. The books alone, insurer might have charged $1,200. Then the mock examination, insurer might have charged, let's say, $4,000. $4,000. So these are the standalone prices. Now, if you should put the three together as individually, let me punch that together: 7,800, 1,200. Oh, I could do that. $13,000. So really, individually, insurer would have received $13,000, but insurer actually charged Tracy for $10,000. So the question we then ask ourselves in step 4, which is where our focus is to allocate. How do we now share 10,000 that we are receiving for each of the services that we are rendering? That is the fourth step: allocation. Allocation. So see how we're going to allocate this quickly. So tuition, books, and then mock. Very simply, or very simple here. So tuition is going to take what? 7,800 over 13,000 over 13,000 multiplied by the transaction price, which is the $10,000 here. So we punch it out, see the answer we get. Second scenario, $1,200 over 13,000 by 10,000. We punch that out. Third scenario, that is $4,000 over 13,000 times $10,000. We punch that out. So let's punch these out respectively and see what we get. 7,800 by 13,000 times $10,000. That's going to be $6,000. Nice one. The next one, it's going to be 1,200. and that's going to be an approximately maybe $923. Then the last one will be 4,000. That's a little over 3,077, something like that. So that is the allocation of the transaction price. Step 4. Are we okay? If there are any questions, you put it in the chat for me. I see some of you guys joining. You are welcome. This is IFRS 15 that we are dealing with, very fundamental accounting standard for financial reporting and corporate reporting. So if you join us, give us a thumbs up on the video, guys. Let's get some more engagement on the video. Share the video as well. Let's reach more people or more students. But most importantly, let me hear from you in the chat. Any questions you have for me, put it in the chat for me if you're on YouTube, or put it in the comment section for me if you're watching us on Facebook, as we continue with our discussion. So that is step 4. Allocate the transaction price. Allocate the transaction price. So step 1, identify the contract. Step 2, what are we doing in the contract? Step 3, how much are we charging for the contract? And then step 4, we share or allocate the transaction price to the performance obligation. We allocate the transaction price to the performance obligation. Then the step 5 is what I told you in the beginning of our discussion, and that is recognize revenue when or as the entity satisfy performance obligation. That's what we're talking about here. That's what we're talking about here. So that is the 5 step. So if Nhyira enters the contract with Tracy, maybe at the date of entering into the contract, Nhyira may transfer books. So probably on the date that they entered into the contract, revenue will be recognized, will be the book, which is 923. That will be the revenue we'll recognize. Why? Because that is the performance obligation that has been satisfied. That is the performance obligation that has been satisfied. That is the idea about the 5-step framework. So like I mentioned, the examiner can ask you this for 3 to 5 marks in the exam hall. It's a theory written area that the examiner can throw at you. So it is very important you understand the treatment very, very well. So these are the 5 steps that we go through for revenue recognition. Any questions, please? Let's get some conversations coming in quickly, and let's take our first question to apply the principles real quick. Any questions for me? Put it in the chat, the comment section for me. Let's see, what do we have here? Senam Bright said, hello, Nhyira. Hi, Senam. I hope you're doing well. Ebenezer Mensah with a thumbs up. Thank you, Ebenezer. Stephen Futterson said, hello, Nhyira. Thank you for these classes. Always a pleasure. Abigail Asari said, Sir, I hope you're doing well. Yes, Abigail, I'm flourishing, and I hope you're doing well also. Timothy said, good evening, said the last sitting. How do we recognize the revenue in notes 1? We'll be getting into that. We'll be solving full practice questions later on after we go through a couple of the standards. But I will look at what you're saying and then provide you with some answers in that regard. FR, okay, that's fine. We're going to look at that. Muzi said, I think your first name. Forgive me if I don't mention your name right, okay? What we got? Good evening, sir. Following the lectures very well. Thank you, Muzin, for that. Memuna said, sir, thank you for the class. Always a pleasure, Memuna. What we got? Suleimana Bubakar said, hi, good evening, sir. Good evening, Suleimana. Thanks for joining us on the stream today as we continue with our discussion here. I think today Facebook, it's a little bit quiet on us. For those of you who are watching on Facebook, if there are any questions also, you can put it in the comment section for us, and we're going to be taking them up. So now that we've, discussed the principles, let's take a question and apply it. I get it, because that is the way we go through this. You go through the principle, then we apply the principle. So let's see what we got in relation to this quickly. Osei Akoto said, "Hey, Nhyira." Hello, Osei Akoto. Thanks for joining us on the stream today. Richard Gabion said, doing well. Say, okay. Thank you, Richard. Nana Don said, keep up the good work. Thank you, Nana Don. Thank you, Nana Don. The reason I'm laughing is the name Don. You know, and if you have read an article on our website about me, like my stage, one of the articles on my website, when I was high school, my nickname was the Don. You know, the Don, and Don is a professor of a university, but it also has another meaning, which means leader of criminal. And there was one senior like that who was taking that second definition to describe who I was. So that's why when I saw the name Nana Don, just went to memory lane a little bit to remember that. Okay, Beneza Mensa said, what if the performance obligation is not divisible? How do you allocate the transaction price? Okay. If the performance obligation is not divisible, meaning that it's a one-off thing, then that will mean we will look at the percentage of completion. That is the second part of the standard we will look at tomorrow. So, because if it is a house we're building, then we will recognize revenue based on how do we call it, the percentage of completion on the job. So if it is not divisible, then the transaction price is going to be 1. But in that case, because we cannot allocate, we will recognize a portion of the transaction price as revenue based on the percentage of work completed. And we'll look at that tomorrow when we are looking at where performance obligation goes beyond one accounting year. Are you getting it, Ebenezer? So that is the deal there. But when we get there, you will understand it pretty well in that regard. Beck Siam said, say hi, Beck. Please, can I see the steps again? Oh, okay. I'm gonna bring that up in a moment. Nana Don said, "Ha, you are right, sir." Yeah, okay. Thank you, Nana. Okay, so let me bring back my screen. Let's go. Someone said you want to pick something. The 5 step is actually in the book. So step 1 is identify the contract with the customers. Step 2 is identify the performance obligation. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the performance obligation. And then step 5 is to recognize revenue as or when the performance obligation is satisfied. Beck Siam, let me know if that it's good for you in that regard. Okay, so let's take a question quickly. Very simple illustration. Those of you with my book on financial reporting or corporate reporting, this is in your book. If you happen to also enroll in our full courses online, this question is also in your question kit. Okay, so if you open your question kit, this is in your question kit as well on page 75 in the question kit. So if you enroll in our full FR or CR class, you will find this question in your question kit. Or if you have the book also, you can find it in the book. We want to use that as a guinea pig to illustrate what we are talking about here. If you don't have the book, then you just take a screenshot, okay? Just take a screenshot and you'll be good. So let's go and let's see what we can do in that regard. You ready? Let's go. How should Tele PLC recognize the revenue from this plan in line with IAS 18 and IFRS 15? Remember what I told you in my introduction? In IAS 18, we recognize revenue, boom, when the contract is signed. But in IFRS 15, we recognize revenue when the performance obligation is satisfied. So let's see how revenue is going to be recognized generally when we are dealing with the issue about IAS 18 and IFRS 15. Let's go. Aaron enters into a 12-month telecom plan with a local mobile operator, Tele PLC. The terms of the plan are as follows. Aaron monthly fee is $100. Aaron receives a free handset at the inception of the plan. So stay with me carefully. We have to go through the process, the stages. You ready? Let's go through the stages together to identify what the heck is going on here. I think I got to open it here. Let's see. Identify the contract with the customer. So step number one, is there a contract with the customer? Yes. How? Because we are told Aaron entered into a 12-month telecom plan, and there are conditions that he will pay monthly fee and he will receive a free handset as well in that particular case. So yes, there is a contract with a customer. Step number one met. Step number two, performance obligation. What would Tele PLC do under this contract? What is Tele PLC going to do under this contract? Stay with me carefully. Aaron will receive a free handset. So Tele PLC number one will provide a free handset. But on top of that, it's a telecom company. So Aaron is making a monthly payment of $100. For that reason, Aaron must also receive internet services. So the second performance obligation here is the internet services. So there are two things that Tele PLC is doing here, giving a handset to Aaron. Then for every month, they must provide Aaron with internet services because it's a telecom company. Are you getting the step here? So that is step two, performance obligation. Step two, performance obligation. So step one, is there a contract with a customer? Hell yes, there is a contract with a customer. Step two, what is the performance obligation? What are we doing here? We are giving a handset and also internet services. Okay, let's go to step three. Step three says determine the transaction price. How much is Tele PLC receiving under this contract? That is the transaction price. So if we look at the transaction price situation here, we are told that it's a 12-month telecom plan and Aaron is going to pay $100 per month. So it means that the transaction price is going to be $100 per month multiplied by 12 months, and that is going to be $1,200. Are you following the step? So, is there a contract with a customer? Yes. What is the performance obligation? Free handset and internet. What is the transaction price under the contract? $100 every month for 12 months, and that is $1,200. Then let's see. What is the fourth step? Step number four is to allocate the transaction price to the performance obligations. So we've seen that they will provide free handsets and then internet services. So the question we'll ask ourselves is, what is the standalone prices for these guys? What is the cost of the handset alone and what is the cost of the internet alone? So let's see. Tele PLC sells the same handset for $300. Ooh, so the handset is $300. And the same monthly prepayment plans without the handset for $80 per month. Okay, so had it not been the handset, the internet service would have cost Aaron $80 times 12. And that is going to give us an amount of $960. So these are the standalone prices. So if we add the two up, that gives us $1,260. Are you getting the picture? That's the $1,260. So it is based on this that the examiner is asking you, how should the transaction be recognized in line with IAS 18? Pretty simple. Under IAS 18, what is going to happen is that the handset will be written off as marketing expenses. All right. Then the monthly payment of $100 will be recognized as revenue. That's all. That's all. Under IAS 18, that's what we're going to do generally. That's what we're going to do. So look at my journal entry here. With IAS 18, the free handset will be treated as a marketing cost. As such, we only recognize revenue for each month as and when it's received. So once the month is due, we debit cash or receivable if Aaron has delayed the payments, and then we credit revenue. That is all. So under IAS 18, the handset will be treated as what? Marketing cost. Because that is what we are using to entice people to come and sign up with a plan and subscribe to the service or subscribe for the service. Does that make sense, please? That is IAS 18. That's what we do. So in IAS 18, we don't care about, oh, what is the performance obligation? What is the standalone price? What is the transaction price? What is the allocation? No, we don't do all that. It is in IFRS 15 that we would have to go through the 5-step framework. So under IAS 18, that will be what we do. The handset will be treated as marketing cost, meaning written off in the P&L account. Then the annual or monthly payment will be recognized as revenue in the books of the entity. But what if we are in IFRS 15? That is what we are excited about. If we are in IFRS 15, the handset is not free. The handset cannot be written off as an expenses, as a marketing cost. No, the handset is a service we are rendering. It's something we are doing under the contract. So then we need to allocate the transaction price to the performance obligation. So we go to allocation of transaction price. So stay with me very carefully here. There is a handset there. So with the handset, it's $300 over the total of 1260 multiplied by the transaction price of 1,200. That will be the value for the handset. Then we bring in the internet services, or whatever service that they will provide them. That's 960 over 1260 times 1,200. So we punch that out. Let's see what we got. If there are any questions, put it in the chat for me or the comment section for me so I can take it. So I'm getting 286. Then we're going to have 960, 1200. Oh, sorry. 960, 1260. I'm getting 914. So that is the allocation. That is the allocation. That is the allocation. So that's step 4. Now, step 5 says recognize revenue as and when a performance obligation is satisfied. So this is where you have to be careful and be mindful of something very well. Under IFRS 5, revenue can be recognized at and revenue can be recognized over. When we say revenue can be recognized at, it means the date of the contract. Did we do anything at the date of the contract? If we did anything at the date of the contract, if a performance obligation is satisfied at the date of the contract, then we will transfer revenue at the date of the contract, or we will recognize revenue at the date of the contract. But sometimes the work is over a period of time. So then there is a portion of revenue that will be recognized over the contract period. Are you getting it well? So revenue can be recognized at, revenue can be recognized over. So at the date that we signed the contract, did we satisfy any performance obligation? If the answer is yes, why not? Go for it. If the answer is no, then we were going to be recognizing the revenue at some time in the future. Why did I bring that up? We go back to Aaron's question. How do we recognize revenue? So at the date that he entered into the contract, what do you think Tele PLC Limited will do? They will give him a handset. So what is going to be happening is that at the date of signing the contract, at the date of contract signing, Tele PLC will provide Aaron with the handset. As such, a revenue of 286, which is the handsets allocated revenue, is recognized. Sounds good? But remember principle number 3 in our takeaway. I said, where a performance obligation is satisfied, but the amount is yet to be received, the entity shall recognize revenue with a contract receivable. So what's going on here? You realize that even though we've signed a contract, we have received this. So at the date of the contract, this is the journal entry. Journal entry. We've not received any money from Aaron at the date of the contract because he will start making payment probably at the end of the month. So we've not received any money from him. So we're going to debit contract receivable with 286 and credit revenue because we've satisfied the performance obligation. Sounds good? That is at the date of the contract. So the handset, the revenue in respect of the handset will be recognized at the date of the contract. But the internet service portion of the revenue will be recognized over the 12 months period. Okay? To be recognized over the 12 months period. Are you following me well? To be recognized over the 12 months period. That is the life of the contract. So the question we then ask ourselves is, how do we do this? Remember, this contract asset in the receivables will not come in one block. Aaron will be paying every month. So what is going to happen is that we're going to look at the monthly allocation of the handset and monthly allocation of the internet services. So monthly allocation of handset, that's going to be the handset amount of 286 divided by 12, and then the internet service amount also 912 over 12. So let's punch that out. Now, why are we doing this? I'm going to explain that to you in a moment. 286 divided by 12. I'm getting 24. 914 divided by 12. I'm getting 76. Stay with me carefully. So remember I said the internet service will be recognized over 12 months. That is why we are doing this. So every month, the internet service will recognize 17. So when we receive monthly payments or monthly payments from Aaron of $100 from Aaron, what will be the double entry? This is it. You debit cash with the $100, credit revenue with the 76, okay, the over. the internet service, which is over 12 months, then 914, then the balancing figure is credited to the contract asset. Do you understand? Contract asset. That's the balancing figure. And that's the 24. So this is what happens every month. And we'll be doing this for the 12 months. And at the end of the 12 months, the contract asset or contract receivable that we recognized here will become zero by the end of the 12 months. And that is how we deal with revenue recognition. Any questions? That's the idea. So we said under IFRS 15, we need to identify the contract. Is there a contract with the customer? Yes. What is the entity doing under the contract? Free handsets, internet services. Number 3, what is the transaction price? The amount receivable by Tele PLC, $100 by 12. So how do we then allocate? The standalone prices are free handset is $300, or the handset is $300. The internet service would have been $960. We add it up, it's $1,260. Okay, so we allocate. When we allocated, the handset is $286. The internet service is $914. Okay, we are saying that the handset to be recognized at the date of the transaction, because immediately we signed a contract with Aaron, we're going to give him a handset. So at the date of the transaction, we recognize revenue. Then the internet service portion will be recognized over the period of the 12 months. So how much is chargeable or allocated every month to these performance obligations? And we have done it. So every month when the $100 become due, we'll debit our cash because we receive that, and then we'll credit revenue with 76, and the contract asset which we debited earlier with 286 will now be credited with 24. And we will do this over the next 12 months, and at the end of the 12 months, the contract assets or the contract receivable accounts becomes zero. That is the idea about revenue recognition when it comes to dealing with IFRS 15, the default treatment. Any questions? Everybody good on that? Everybody good on that? Let me know. I'm seeing some charts coming in. What do I have here? Jamal Dean said hi. Say hello, Jamal Dean. Thanks for joining us. What else we got? Beck Siam said, thank you, got it. All right. Then we have Junaidu said, hi, sir. Good day. Sorry, hi, Nhyira. Good day, sir. Junaidu from Nigeria. The topic is very interesting. I'll write financial reporting examination, CITN, on 12th October 2022. More advice needed from you. Okay, so Junaidu, financial reporting. I don't know what CITN. What's CITN? I could cross check that a little bit. But it depends on the structure of the exams. But on the average, what's going to be happening is that the accounting standards is going to be very critical there, that you must understand. So, okay, the Chartered Institute of Taxation of Nigeria. Okay. So every financial reporting exams, the accounting standards will be critical, like you just identified today. So you have to ensure that you are strong in the accounting standards. Now, which accounting standards? Definitely the grandmother IAS 16 property, plants and equipment. Then its associated standards like IAS 12 income tax, like IFRS 15 that we're talking about revenue from contract with customers, like IAS 23 borrowing cost, IAS 20 government grants, the issue relating to IAS 36 impairment, IAS 38 intangible assets, IAS 37 provisions, contingent liabilities, contingent assets. All these standards are going to be very fundamental that you need to ensure that you are strong in order to position yourself to ultimately pass the examination. Then Interpretation of financial statement ratios, very crucial there. You can check on the channel. We have a couple of contents on the channel relating to ratios that can assist you in that regard. So you got to be strong also on ratios. Then certainly the financial statement preparation in general, in order for you to know how to prepare the financial statement. Then the boss consolidated financial statements. Like I said, I don't know the structure of your exam, so I am careful about the things that I'm saying, but it depends on the structure of your exams. However, in the financial reporting exams, these things are going to be the thematic areas that you need to focus on. Standards, really huge aspect, 40% probably, or 30%, depending on the structure of the exams. And then financial statement preparation, consolidated financial statements, and ratio analysis, you should be good in that regard. So what I would say is that make sure you strengthen yourself with these areas, and you should be good. You should be good there. Any other questions for me? Any other questions for me? Any other questions for me? Let's see. What do we have here? Uh Kwame JD, Socrates, Kun Aguero, Aubrey J, Humphrey, Ambrosi Ahonga. Thank you very much, guys, for the engagement on Facebook. I really appreciate. And for those of you on YouTube with a thumbs up, also, thank you very much for that. Let me bring back my screen real quick, and then we see. So that is the idea about the default recognition of revenue. So as you can see, very sweet, simple, straight to the point. Very sweet, simple, straight to the point. Now, remember I told you that there is some relationship with this one with IFRS 16 leases. We'll talk about that pretty later on, sorry, in our discussion. But let me just give you some a note here for you to take away. If there is a statement in the question and it says that, oh, it goes this way. So let me put it this way, where the entity sells goods with a repurchase option. And the amount is included in revenue. This is not a sale. This is not a sale. The company has sold the goods, but has a repurchase option to it. So it is not a sale. And I'm going to explain this to you later on under IFRS 15. It is called a financial arrangement. And the goods have been used as collateral facilities. The goods have been used as a collateral facility. So under that deal, under that kind of illustration, you don't treat it as revenue. So you have to remove the amount from revenue by debiting revenue. Whatever amount that was put there, revenue has a credit balance. So you subtract. When we say debit revenue, we mean subtract it from revenue. So you're going to subtract from revenue, and then you're going to recognize a financial liability, okay, which is the fair value of the amounts received. Fair value of the amount received. Then, because it is not a sale, the cost of sales of the goods must not be recognized, and the goods must be part of closing inventory. So what is going to be happening is that you're going to debit inventory, to be specific, closing inventory. Then you credit cost of sales. So you subtract that, the cost of the goods from this, and that is with the cost of the goods. With the cost of the goods. Like I said, I will explain this to you later on when we are solving questions. But I want you to understand the idea in that regard. I want you to understand the idea in that regard. So when there is an entity and they they sell a good, they sell some goods, but with a repurchase option, it is not a sale. It's a financial arrangement. Okay, it is not a sale. It's a financial arrangement, and the goods have been used as a collateral facility. So in that case, we have to remove the revenue from revenue and rather recognize a financial liability. Then the cost of the inventory that is supposedly given to the buyer will have to be included in the closing inventory. So you have to debit closing inventory. That's why we debit inventory. And you have to remove the cost from the cost of sales. That's why you credit the cost of sales, because you've not sold it, so it cannot be part of cost of sales. Cost of sales is an expense. It keeps a debit balance. So when we say credit cost of sales, we mean deduct it from cost of sales. When we say debit inventory, inventory is an asset. It means add it to inventory. I hope you are getting the idea. And once you do this, we calculate finance cost on the financial liability and recognize it in the P&L accounts. So you calculate finance cost on the financial liability and recognize in the P&L in the profit or loss. The interest rate will be given to you in the exam hall, so you don't have to think about it. And that finance cost, you debit P&L. So you're going to debit profit or loss because it's an expense with the finance cost. And then you credit the financial liability. You credit the financial liability. So what is going to be happening is that when we go to the statement of financial position, we're going to have financial liability being the fair value of the goods plus the finance cost that we calculated. And that's the carrying amount at the end of the year. Are you getting it? That's the idea. This is typically under IFRS 9, like I said, financial instrument, but because it has that tone of revenue, and you would think, oh, we can recognize actually a financial liability. So this is covered in under IFRS 9. But I wanted to bring it up to just let you know the treatment for this as well. So that is the issue about that. Any questions, please? Any questions? Any questions? Any questions? Let's see. What do we have here? Love Your Country said, hi, sir. Thanks for the IFRS. I vote for last week when you asked. Kindly solve some exams questions, including impact of variable and fixed, non-cash consolidation, and sufficient financial components. Non-cash consolidation. Yeah, we will look at consolidation later in the discussion. So don't worry, we'll be talking about that. And we'll be taking, like I said, we'll be going through the standards. And then as we cover a couple of the standards, then we'll now take a full question. And then we go through the full question on the live session like this. And then we will be able to then put the pieces together and answer a very practical question in that regard. Everybody good on that? So that's it about that. Basically, when we talk about IFRS 15, revenue from contract with customers, the first part of the standard, I'm going to be concluding around here today, and God willing, tomorrow we will look at the second part of the standard where performance obligation goes beyond one accounting year. So if performance obligation goes beyond one accounting year, what do we do? Remember, the stream has already been fixed or has been scheduled. So right after this stream, you will see that. Subscribe to the channel if you have not subscribed to the channel, and click the bell notification icon, because once we schedule a stream like that, YouTube will send you the notification so you can put it on your remind me, and once I go live, you'll be able to join on the stream so I can assist you better to prepare well for the examination and pass the examination. So thank you very much for joining me on the live stream. We're going to be concluding around here today. Like I said, this week we are going to hopefully cover a couple of the standards. Tomorrow we'll look at the conclusion of IFRS 15. On Wednesday we'll go into IAS 33, earnings per share, one of the most interesting accounting standards that we need to understand as well. Then Thursday, Friday, we will continue with some other standards. So possibly, maybe over the weekend or Monday, we'll be taking some full questions and see how we can play around when the standards come together in general. So that's it about that. Have a great week, and I hope that I'll be catching you throughout the week as we continue with our discussion. And assist you to pass the examination. Thank you very much. Stay safe and stay blessed. Bye bye.